Have you ever found yourself wondering what value investing is and why it's considered one of the best strategies for investing? Well, let's dive into this fascinating world of finance. Value investing, as the name suggests, is all about values. It's like a treasure hunt, where the treasure is undervalued stocks. These are the stocks that are trading for less than what they are truly worth, their intrinsic or book value. Imagine walking into a store and finding an item that is priced far less than what it's worth. That's essentially what value investing is. It's about finding those hidden gems, those stocks that have been overlooked by others, but hold great potential. It's about being patient and willing to dig deep to uncover these opportunities. Now, you might be wondering why value investing is considered one of the best strategies for investing. Well, it comes down to the principle of buy low, sell high. Value investors seek to buy stocks when they are undervalued and then hold on to them until their price reflects their true worth. This can result in substantial profits when done correctly. It's a strategy that has been used by some of the most successful investors in the world. Think of Warren Buffett, for instance, who famously said, "Price is what you pay, value is what you get." This encapsulates the essence of value investing. It's not about chasing the hottest stocks or trying to time the market. It's about finding quality stocks that are currently underpriced and waiting for the market to recognize their true value. However, it's also important to note that value investing requires a good deal of research, patience, and a willingness to go against the crowd. It's not for the faint-hearted or for those looking for quick wins. In a nutshell, value investing is all about finding diamonds in the rough, or in simpler terms, purchasing quality stocks at a lower price than their actual value. Now that we've defined value investing, what are the principles behind it? Well, the core philosophy of value investing revolves around three key principles: intrinsic value, margin of safety, and a long-term investment perspective. The first principle is the concept of intrinsic value. Intrinsic value is the actual worth of a company, irrespective of its current market price. Value investors delve deep into a company's fundamentals, looking at factors like earnings, dividends, and assets to determine this intrinsic value. They do not get swayed by market fluctuations or trends. Instead, they focus on the underlying worth of a business. In simple terms, intrinsic value is like the true north for value investors, guiding them in their investment decisions. Next up is the margin of safety principle. This principle is a buffer against the uncertainties of investing. No calculation of intrinsic value can ever be perfect. There are always risks and uncertainties. The margin of safety is there to account for these risks. It's the difference between the intrinsic value and the price you're paying. In essence, the greater the margin, the lower the risk. It's like buying a dollar bill for 70 cents. That 30-cent difference is your margin of safety. The third principle is having a long-term investment perspective. Value investing is not for those seeking quick profits. It's a strategy for those who are patient and willing to wait for the market to recognize the true value of a company. This principle is about understanding that the market can often be irrational in the short term, but over the long haul, it tends to correct itself and reflect a company's intrinsic value. These principles form the bedrock of value investing. They help investors navigate the turbulent waters of the stock market, enabling them to make informed decisions based on solid fundamentals rather than market hype or fear. By adhering to these principles, value investors aim to protect their investments against adverse market trends and generate substantial profits over the long term. Understanding the principles is one thing, but what benefits does value investing bring to the table? Well, the first and perhaps most enticing benefit is the potential for significant returns. You see, value investing is all about finding those diamonds in the rough, those companies that have been overlooked or undervalued by the market. This isn't about jumping on the latest trend or hot stock. It's about diligent research, patience, and a keen eye for value. When a value investor spots a company whose intrinsic worth is greater than its market value, they found a potential gold mine. Buying the stock when it's undervalued and then holding on to it until the market corrects itself can lead to substantial gains. It's akin to finding an expensive antique at a garage sale for a fraction of its worth. The second major benefit of value investing is risk reduction. Now, it's important to understand that all investing involves risk, but value investing, by its very nature, seeks to minimize that risk. How so? By focusing on companies that are fundamentally strong but undervalued, value investors build a buffer or margin of safety between the price they pay for the stock and its actual worth. This margin of safety provides a cushion against market volatility and decreases the potential for loss. Lastly, but certainly not least, value investing can lead to the acquisition of undervalued stocks that provide consistent dividends. This is a significant benefit for those looking for a steady income stream from their investments. Many value investors specifically look for these types of companies, ones with a history of paying reliable dividends. It's like having a tenant who consistently pays rent on time, a steady, reliable source of income. In conclusion, value investing offers the potential for significant returns, a reduced risk profile, and the possibility of consistent dividends. It's a strategy that requires patience, discipline, and a thorough understanding of a company's true value. But the rewards can be well worth the effort. Value investing, when done right, can pave the way for substantial financial gains and a strong investment portfolio. Like any investment strategy, value investing isn't without its risks and challenges. One of the most prominent risks lies in the potential of selecting a stock that is cheap for a reason. It could be that the company is in decline, or its industry is facing challenges, and its low price isn't just a market oversight. Another challenge is the test of patience. Value investing is not a get-rich-quick scheme. It requires a long-term perspective, often waiting years for a company's intrinsic value to be recognized by the market. Additionally, the risk of market volatility cannot be overlooked. Even if you've picked a company with strong fundamentals, market sentiment can swing wildly, causing significant short-term price fluctuations. Despite these risks, with diligent research and patience, value investing can prove to be a rewarding strategy. It's a game of endurance and resilience where the steady and informed often reap the greatest rewards. So, there we have it, a simple breakdown of value investing. We've explored this investment strategy that's all about identifying undervalued stocks and investing in them with the expectation that their intrinsic value will eventually be recognized by the market. We've dissected the principles that guide this approach, such as the importance of looking beyond the surface, understanding the inherent value of a company, and having the patience to wait for the market to catch up. We also delved into the benefits of this strategy, which include the potential for significant returns and a margin of safety. But let's not forget the risks and challenges that come along, like the possibility of misjudging a company's true value or being tested by market volatility. Remember, investing is a journey, and like any journey, the more knowledge you have, the easier it becomes to navigate. So keep learning, keep investing, and most importantly, keep growing your wealth.